Record start.
All right. Thanks, Rob. And thanks everybody for joining us today for our inaugural QuantStreet Capital State of the Markets webinar. My name is Jake Saba with Apex Capital Distributors, and we're partnering with QuantStreet to bring their OCIO, ICIO services to RIAs and independent advisors. So I'll just give a quick intro here of QuantStreet and our webinar today, and I'll be handing it over to Dr. Harry Mamaysky. So QuantStreet Capital, as you can tell by the name, is a quantitative-based in-source chief investment officer, portfolio manager, sub-advisor, and we will be sharing their insights, giving us a history of, or a review of 2020, what to look forward, 2022, what to look forward to in 2023, and how they go about doing what they do in measuring the vast amounts of data and metrics from the global marketplace and using that data and machine learning to create predictive allocations, reduce risk, and in all basically making it easier for advisors to spend time dealing with their clients and not having to choose from the thousands of options of mutual funds and ETFs, and do what they do best, stay in front of their clients and hold their hands through the market and create financial plans for them. So without further ado, Dr. Harry Mamaysky, professor, portfolio manager, founder of QuantStreet Capital. Thanks everyone for joining, and Harry, I'll hand it over to you.
Thanks a lot, Jake. So I'm going to hand it over to Isaac Mamaysky, my co-founder, for brief introductory remarks, and then I'll take it from there.
And then we will go right back to Harry, as Jake intended. So hello everyone. To those of you who we know, it's very nice to see you, and to those who we do not know yet, it is a pleasure to have you on our webinar. For those who are not on the webinar, this will be recorded. This is being recorded, so this recording will be distributed after. So just by way of a quick background, we launched QuantStreet Capital a little over a year ago. It's actually a little shocking to me that we just celebrated our 1-year anniversary, but that has just passed. So as Jake explained, QuantStreet, we are an external portfolio manager, and we work with both investment advisors and individual investors. When we work with investment advisors, our goal is to really enable them to focus their time on client management and client development while we handle all the investing. And when we work with individuals, our goal is really to simplify the investing process. So our investors simply choose their risk level. We can help you choose an appropriate risk level, and then we handle all the investing from there. We are brothers, by the way, as you might be able to tell by the last names. QuantStreet was a long time in the making, with a lot of planning. To briefly tell you about us, Harry is our Chief Investment Officer. He is a professor at Columbia Business School, where he is the faculty director of Columbia's program for financial studies. Harry has over 20 years of experience in both finance practice and academia. Prior to his role at Columbia, he was a portfolio manager at some of the world's largest financial institutions. And this is really what makes us so very different from many other asset managers out there. Our strategy is based on Harry's academic research combined with his industry experience. It gives us a very unique approach to investing, and something that's less common than what you'd see with many other asset managers. As for myself, I am a corporate attorney, and I serve as our head of operations and our chief compliance officer. So in terms of the way we invest, and then I'll turn it over to Harry. We have a choose your risk and choose your tax efficiency model. In a nutshell, what this means is that our investors, they can choose their risk level. We can help identify an appropriate risk level as well. And they choose their tax sensitivity, and we handle all the investing once those choices are made. We currently offer 3 strategies, so a low risk, moderate risk, and aggressive strategy. And our core strategy is the moderate risk option, which targets the MSCI All Country World Index, known as the ACWI, which is a broadly diversified international stock market index. Since our launch a little over a year ago, we have been outperforming ACWI, our benchmark, by about 4.5%. With that, I am pleased to pass it over to my very wise older brother, Dr. Harry Mamaysky.
Great, thanks, Isaac. So I think I read that when Vanguard launched in 1940 and they did their first Zoom call, they actually had also the same naming issues we're having. So I think there's a well-worn tradition for these sort of calls. All right, so I want to talk about a few things just to set the tone of our discussion. I'll talk about the narratives that have been out there in the market throughout 2022. So almost like a bit of a recap of the year. And then we'll talk about an emerging narrative about earnings recessions and other types of recessions. I'll hit on why quantitative strategies make a lot of sense, and then talk a little bit about how we've done since we launched and also what our portfolio has looked like. And then I will briefly mention a new tool that we've been developing that I think will help in our OCIO and retail businesses as well. So let's jump in. So a really great tool, for those of you who haven't seen it, is this Google Trends website. So what it allows you to do is you can go on Google and you can actually ask Google, how many searches do you see for certain keywords? And then Google will tell you. So that's what I've plotted here. And I want to just briefly go over some of the emerging themes of the year that people have been focused on. So when the year started, if you remember, it started sort of famously with like that Larry David FTX commercial during the Super Bowl. It was still peak NFT mania. People were buying crypto left, right, and center. And all of the things that people would become worried about later weren't yet really front and center for investors. People were looking at, non-fungible tokens and other stuff like that. So at some point that sort of dissipated, and people, the search key terms in Google for NFTs subsided. And then of course we had the massive, human tragedy of Russia's invasion of Ukraine, which unfortunately continues to this day. And with all of the commensurate upheaval in global markets that entailed. Throughout the year, there was a building narrative of concern about inflation. And I'll talk a lot more about that in this call. It started off from where people thought we had this sort of, temporary spike in inflation on the back of the economy's emergence from COVID-19, but then it sort of built over the course of the year into really full-fledged, inflation spiral concerns. But recently that narrative has also begun to subside, and I'll show you some of the reasons why that's the case. And then the final thing to mention is there's an emerging narrative out there about, okay, we used to think inflation was the big problem in the world. We don't think that anymore, although that's a sudden shift for some of the prognosticators because they were convinced inflation was the big nasty evil in the world as of like a few weeks ago, but they're no longer concerned. And now the concern is that the tools used by the central banks to tame inflation, actually that will cause a very big recession. And we'll talk about that as well. So this is sort of the new narrative that's in the market, is this idea that the inflation problem is morphing into a earnings recession problem. And so we'll have some evidence on that as well. So where does this inflation thing come from? I mean, just a few charts. I mean, I'm sure you've seen these. So we have two measures of inflation in the US, two broad measures. This consumer price index, which overweights housing in its components, and the PCE, which is part of the national accounts data, personal consumption expenditure. So both of those spiked really last year, but people thought those spikes were transitory. And why the spikes happened was basically post-COVID-19 supply chain disruption. So people, like the truck drivers, where did my thing go? Had, found other work. And when the economy sort of reawakened, there was stuff moving goods from point A to point B. But there was really a belief that that would be a transient thing and things would kind of normalize. And then what really happened was the Ukraine war. And the Ukraine war just exacerbated all of these already troubling trends to where we now had an energy price spike. We had food shortages in many places because Ukraine couldn't export their grain harvest. So this really kind of fed into this post-COVID-19 supply chain disruption and created almost this perfect storm of inflationary, problems that kind of feed into expectations of consumers. And then that was sort of the straw that broke the camel's back, so to speak, was policymakers at the central banks, at the Fed and so on, began to be really concerned about inflation expectations becoming entrenched in the consumer psyche. And, that is a big no-no in the macroeconomics world. And so then the central bank decided to act. And oh, by the way, this inflation problem was not only specific to the US market, this was actually a global problem. It manifested in, Australia, Germany, Japan, all the developed countries in the world. Basically, we're seeing the same kind of dynamics that we were seeing in the US. The central banks had to act, so they acted. So this chart that you see here is the Fed's, the Federal Reserve's Fed funds target rate. So this is the rate at which the Fed asks the New York Fed's markets desk to maintain the Fed funds lending rate, and the Fed engaged in sort of these, very massive rate hikes over the course of this year to, tighten credit creation in the system and basically start addressing the inflationary problems that the central bankers perceived us to have. So that's one of the elements of central bank response, and other central banks did the same thing. So there's been this global, hiking of short-term interest rates that has tightened credit conditions. In addition to that, the other concern out there is on the quantitative tightening side. So if you remember, if you look at the Fed's balance sheet, which is this graph here, going into the global financial crisis of like 08 and 09, the Fed maintained a balance sheet of roughly 5% of GDP. And then after Lehman's bankruptcy and after the whole financial system was on the brink of collapse, and I remember that very well because I was working at Citigroup at the time, the Fed acted, they bought up a lot of mortgage-backed securities, longer-dated treasury bonds, and so the Fed's balance sheet really increased. And then the Fed began to unwind its balance sheet, sort of not by selling, but by letting maturing securities just roll off without buying new ones. And then COVID hit, and then the Fed and other central banks engaged in a whole new round of quantitative easing. And where that left us going into this inflationary spiral was the Fed's balance sheet having ballooned to about 30% of GDP. And the same thing can happen to the ECB, the BOJ, and the Bank of England, and other sort of developed market central banks. So in addition to the concerns that people have about the tightening of credit conditions that can be caused by an increase in short-term interest rates, there's an additional concern in the marketplace about what will happen when the Fed rolls down this sort of quantitative easing state of its balance sheet in a path called quantitative tightening. And I mean, frankly, I think that is a risk, and we're not totally sure how all of that is going to play out. So that is one of the overhangs that's in the market now. So this was the response of the central banks in the world, including the Fed, to that inflationary spike that started to look like it wouldn't be transient anymore post the Ukraine conflict. What's happened recently is there has been some fairly good news on the inflation front. I'm going to show you a bunch of pictures so you can sort of follow along. The first thing to look at are break-even. So what's a break-even? 10-year break-even is the difference between 10-year TIPS, which is Treasury Inflation Protection Security, and 10-year Treasury notes. It's basically the market's expectation of what inflation will look like in the future, with a little bit of a risk premium that's in there in nominal bonds for people to take on inflation risk. The point of this is to say that while inflation itself went as high as, 6, 7, 8%, inflation expectations really never got that high. The market never thought the Fed would allow inflation to really get out of hand into like the 5, 6, 7% handle. So inflation break-evens, which is kind of the market's belief about what inflation will look like in the future, maybe peaked at like 2.8% and then began to go down. And in fact, what you can't quite see here, but right here at the end, basically like this week, I think today inflation break-evens are down another 10 basis points, 0.1 of 1%. So there's been a big coming down of this market implied inflation expectation, which is good news, which means what the Fed is doing is actually working. The other thing that's been happening, if you've been reading the news, the Wall Street Journal has carried a bunch of articles talking about Target and Walmart having a glut of inventory. So if you're a believer in the inflationary spiral story, it's not consistent with that story that, there's a ton of inventory sitting at Target and Walmart that they basically can't sell. One way to see that is you can look at retail inventories, their growth year over year, which is published by the Census Bureau, the statistic, and this has gone up a lot. I mean, it's basically saying that our retailers, it's not like stuff is flying off the shelves, it's that they basically can't sell the stuff that they have. And again, that's not the ingredients for an inflationary spiral if your major, retailers in the country have a glut of inventory. That just isn't how inflation typically manifests itself. The other thing that's happened is commodity prices, which had gone up a lot on the back of the Ukraine conflict, have begun to come back down. So this is the S&P Global Stocks Commodity Index, and it's begun its descent down. And this might not fully reverse because there's still a lot of commodity pressures in the market. I'll show you a chart in 1 second, but it's sort of off these peak levels, which is also a good inflationary sign. And then the other thing that happened, this is about a month ago now, November 10th. So November 10th, 8:30 a.m., the CPI number is released. And for the first time in 3 or 4 months, the CPI number comes in better than expected. What happens from the close of the day prior to the close of November 10th, the S&P rallies by about 3.35%, so 3.33%. So massive rally in the market on the back of this better than expected inflation number, which is kind of the first better than expected inflation number that we've now seen for several months prior to this. And this begins to change people's expectations about what the inflation story is going to look like. And then the final chart, a little bit of a cautionary tale, is one of the things we've done in the US. The Biden administration did a massive release from our strategic petroleum reserves. And so if you look at crude oil inventories published by the Department of Energy in the US, those have actually become depleted. So there is now a strong bid in the market to buy barrels of oil when, the supply conditions loosen up a little bit. There's going to be a need to restock this massive drawdown of the strategic petroleum reserves in the US. So it seems fairly unlikely, especially with the $60 price cap on Russian oil, that energy prices are going to go too far lower than they are, especially because we have this buyer that needs to step into the market to replenish this reserve at some point over the coming months and years. So this, I think, is a little bit of a cautionary note about what will happen to commodity prices going forward. So this is sort of the totality of the story, is that I think we've pulled back from this precipice of inflation fears. And I think the market is now in a more balanced inflation place, thinking that the central bank tightening of policy that has been in the market, manifesting in higher mortgage rates, manifesting in slowing commercial real estate and residential real estate, all of this medicine is sort of working its way through the patient, and ultimately it's going to work. Okay, so the folks who were telling us that the reason you should sell everything you own and hide under your desk is because inflation is happening are no longer saying that. What they're now telling us is that we're going to have a bad recession because all of the medicine that's in the pipeline at this point and the patient is going to slow the economy to such an extent that we're going to have a recession. And maybe, an important manifestation of the recession we will have is that corporate earnings are going to fall. And so that support for stock valuations will sort of be pulled out from under the market. So you have this Bloomberg article, the recession beat grows louder with slowing earnings and the weaker economy. So James McIntosh, who I really respect from the Wall Street Journal, doesn't write a lot of very happy articles. So he's also saying basically, okay, inflation is done. That's yesterday's story. Earnings is tomorrow's story. That's the problem. And I think that's what people are focused on at this point in terms of, something to worry about. Bloomberg just carried an article yesterday saying the same thing. The yield curve is massively inverted. I'll talk about that in a second. And this is probably forecasting a recession. So we've kind of seen that narrative. And then, of course, the famous Nouriel Roubini, who has never seen a thing in financial markets that he liked, is warning us that there is an unavoidable crash on its way. So climb back under that desk and stay there until the all clear sign comes, and that may never come, by the way. So this is the new thing that's out there. It's there's a whole new reason to hide under your desk. So let's sort of, we have this data-driven approach to thinking about markets. So let's look at what the data tell us. So the yield curve is truly deeply inverted. So this is a plot of 10 and 2-year Treasury yields going back to the 1970s. That's in the top. The bottom chart is showing you the difference between the 10-year yield minus the 2-year yield. And that has indeed become inverted in the sense that 2-year yields are usually below 10-year yields because 10-year Treasury bonds are riskier than 2-year Treasury bonds, and people demand that extra risk compensation in the yield. When that relationship reverses, it is because people expect that the Fed tightening that's happening in the short term is going to slow the economy so much that the longer term rates will fall. So we're now in that inverted situation. And indeed, this is the biggest inversion we've had since the inflationary spikes of the late 70s and early 80s. So that is absolutely valid. The 2-stance curve is deeply inverted. But what does that mean? So here's a study that looks at the behavior of economic growth and stock returns in months following an inversion of the yield curve. So what I did here is basically put together the 13 events going back to like the late 70s for which we have data, where the 2-year rate went above the 10-year rate, and then see what happens to earnings, to economic growth in the 2-year period after that inversion happens, and what happens to stock prices. So as advertised, when the 2-stance curve inverts, what happens to industrial production, for example, is it actually experiences negative growth over the next year and then sort of bounces around for the year after. So the 2-year growth path of industrial production after a 2-stance inversion is not great. It is a forecaster of slower economic growth. And I think so in that sense, the prevailing narrative is exactly right. But maybe from an investor's point of view, the other thing to think about is what happens to stock prices. So here's a chart of the S&P 500 index returns going into months when the yield curve inverts, as happened in July of 2022. So typically an inversion is preceded by a fairly strong rally in the market. This study normalizes everything. So the stock level is 100 on the month that the yield curve actually inverts. So starting at this point, what typically happens on average in the 2-year period after a yield curve inversion is stock prices go up about 20%. Now, within this average, there are periods when stock prices fall, and there are other periods when stock prices go up a lot, but on average, they go up 20% in the subsequent 2 years, which people for some reason don't write about that much, but it's actually what happened historically. So from this perspective, it may not be such an enormous tragedy for the stock market's point of view if you have a 2-stance inversion, even though it does forecast lower economic growth. So this is one take on this situation. Another take on the situation is the earnings recession. So what happens to earnings when we have a recession? So this is an event study that looks at the earnings per share of the S&P 500 index. What happens to the earnings per share of the index when you have a trough in economic growth? So the event here is defined as the month in which year-over-year industrial production growth hits its bottom point in a given economic cycle. So you have growth in industrial production, then it dips down, begins to sort of, then grow again. And we're looking at that, low point of industrial production that defines our most recessionary month. So what happens to earnings when we get these recessions? Typically, earnings begin to decline. In the 12 to 6 months preceding a recession, earnings begin to fall. Earnings indeed do decline during a recession between 5 and 10% on average. And then about 10 months after the depth of the trough of the recession happens, earnings begin to increase again. So actually, the forecast for what happens to earnings is also exactly correct. When you have a recession, corporate earnings slow. But corporate earnings are one part of the stock valuation puzzle. The other part is multiple, right? So what is the price of the S&P index? It's the price to earnings ratio times the earnings, right? To think of it in simple terms. So what happens to PE ratios? What happens to that multiple? Well, it turns out that after the trough of the recession, stock multiples actually go up. Why do they go up? Well, because stocks are forward-looking. That's the key insight here. The stock market says, yeah, we're in a recession, but I'm hearing from the corporate management teams that things are getting better. Yeah, their last 12 months earnings aren't that great, but their earnings like a year from now, 2 years from now look fine. So yeah, I'm willing to pay up a little bit, pay 25 P for the S&P, even though that seems high, because I just think earnings will be higher next year. That's sort of the market's mentality. And the net effect of the dip in earnings per share and the increase in the price to earnings ratio is that the stock market itself actually goes up after the trough growth month happens. So what happens to stocks about a year prior to trough growth in the economy? Stocks sell off by about 20%. That's roughly the peak to trough sell-off in S&P this time around. Stocks begin to rally on average, again, 2 months prior to the trough of economic growth. When the economy troughs, stocks go up an average 30% over the next 2 years. On average, again, within that is hidden some variation. Sometimes they go up, sometimes they go down, but on average, they go up. So, is a recession accompanied by a dip in earnings per share of the S&P likely? I would say yes, it is likely. Is it necessarily bad for stocks? Not necessarily. And the other thing to note is if you're waiting for the all clear sign to come from when you begin to see economic growth again, you will have missed, 10 to 15% return in the stock market before that ever happens, even 20%, right? The stock market anticipates this. It doesn't wait to see, oh, things are fine. It sort of creeps up. No one wants to buy, but somehow it still goes up. And by the time things look okay, the stock market is up 20% off its trough. I mean, that's sort of the historical record. That's what's happened historically. So to sum up the narrative and the data, it's true the two-tenths curve is inverted. We probably will have a recession. It's probably going to be accompanied by a dip in S&P earnings, and all of that on average historically has been good for stocks, if you can believe it. And that last part is not often something we hear, but that is actually what the data are telling you. The other thing we've done at QuantStreet, and this is really from the perspective of how to think about asset allocation from a client's point of view, is we looked at the historical performance of stocks and bonds dating back 150 years into the past. So there's a great data set, this website called macrohistory.net. It's free, you can get it yourself. So let me just show you what the numbers look like. So what we did here is we divided the time period for which we have data into 20-year intervals. So 1870 to 1889, 1890 to 1909, and so on. Within each 20-year period, we calculated the average stock return and the average bond return, government bond return in that interval. And so that's what's being shown here. So on average, in the entire 150 years, stocks have gone up 10.5% a year, and bonds have gone up like 4.8% a year. Bonds, think here like 10-year treasury bonds, with some variation. And the other thing that you can look at is, of course, what happens during periods of high inflation. So the big high inflationary period we had was the oil shock of the 70s that led into the spiraling inflation, which was then addressed by the Volcker Fed, which hiked rates, put the economy into recession, and then sort of rates began to fall and inflation began to come down from the early 80s onward until really 2022. Even during that 20-year period, stocks and bonds did relatively well, of course, a lot of fluctuations within that. So the historical record, 150 years of data in the US, actually suggests that stocks can do okay even during inflationary periods, although, of course, these 20-year averages are hiding a lot of volatility that might happen year by year, which we're not capturing here. The other thing that people are talking a lot about is that stocks and government bonds have historically, over the last 30, 40 years, been negatively correlated. What that means is if you're an investor and you own stocks and bonds in your portfolio, on average, when stocks fall, bonds will go up in price, and provide a little bit of a cushion against a fall in value of your stocks. And what's unusual about 2022 is that didn't happen. Like, this is the first year in a while that stocks and bonds sold off in unison. So this sort of negative correlation that we expect to see in the data that's been there for 30 or 40 years, it just didn't happen this year. Now people are asking, but what will happen in the future? What's interesting to observe about this is if you look at stock bond correlations over time. So you look at what, the stock bond correlation from 1870 to 1889 was 45%. So it was positive. They sort of moved up and down together. And in fact, it stayed positive up until the post-World War II period. It was always positive during this sort of early part of the sample. It was negative in the 50s and 60s, positive again during the inflationary 70s, and then negative for the last 30 years. If you think about what is correlate, like what drives that correlation, it's not so much the level of inflation. You can look at this table after. It seems to be like how volatile is inflation. So when you try to line up, like when were there periods of positive correlation between stocks and bonds, it wasn't so much in like time periods where the level of inflation was high necessarily. It was when inflation was very volatile. So when inflation was moving up and down a lot, like 10%, 2%, 10%, 2%, like those sort of fluctuations were causing stocks and bonds to respond to these changing inflation expectations, was causing them to positively co-move with each other. So if we believe that central banks, which I do, will get inflation under control, with possibly causing a recession, which I don't think will be that bad for stocks necessarily, but if they control the current inflationary pressures, if they control people's expectations about future inflation, and if they keep us in this low inflation volatility era, which we've been in for the last 30 years, then stock bond correlations, again, this isn't like a very scientific proof, but at least anecdotally speaking, stock bond correlations are likely to stay negative if we can keep inflation volatility under control, not even the level of inflation so much, just the volatility of inflation. So if that's where we are, stocks and bonds again belong in a diversified asset allocation plan because it looks like the correlation will continue to be negative. Of course, who knows what will really happen, but at least that's what 150 years of data in the US suggests. So we thought this was an interesting piece of analysis to sort of put this stock bond inflation picture into a bigger historical context and understand what's actually happened historically. Okay, so that's sort of the state of the markets. That gets us to now looking at asset allocation, how we have been thinking about that. And also a little bit of a pitch for why we think, quantitative models are useful. So this picture shows you valuation ratios for several global stock market indices. The top picture here is the S&P. What it's showing you is not the price to earnings ratio, it's the earnings divided by the price. This is called the earnings yield minus the 10-year rate. So this is something that people often call the Fed model. So what it is, it basically says stocks should give you a high earnings yield when interest rates are high, because rates are high. When rates are low, stocks are okay to give you a lower earnings yield. And so what you should really be looking at is a relationship between the earnings yield on stocks and the level of interest rates. By that measure, the US is currently at 0, which means our earnings yield is basically 4-ish% because 10-year rates are now, like as of today, like 3.5 or so percent. So earnings yields are about that level. And the earnings yield has been higher in the past. And so by this valuation metric, stocks aren't like super expensive, but they're not super attractive in the US either. When you look at EM stocks, so here's the EM picture, they look much more attractive. If you look at the level of the earnings yield in EM stocks versus the 10-year rate in the US, this is looking at the return of EM stocks in dollar terms, it's much higher. It's like 4-something%. The US is at 0. So then the question is, well, from this argument, do you conclude that you should be all in EM and sort of all out of US stocks? Well, this is where a quantitative model-driven approach really brings value to the investment decision. So here is the output. I mean, it's too many numbers, but I'll sort of walk you through what it says. This is the output of our forecasting model for what the S&P 500 return will look like in the year ahead. The way this model works, as Jake mentioned, we're using machine learning tools applied to a large data set. The model is re-estimated in rolling windows over the data. And importantly, what the model does is every time we re-estimate the model selects a new set of forecasting variables that have been working in the most recent estimation window. So sometimes it will think that valuation ratios are good forecasting tools for the S&P, and other times they won't be useful tools. And it sort of depends what the relationship is between the data and future return outcomes. So if you look at the current model, these are the current inputs that go into our forecasting model for S&P 500. And by the way, these variables are chosen from a bigger set. There's about 30 or so things it could choose from. What it shows are the year-over-year rate of industrial production, an index of economic policy uncertainty, which measures news flow and tells us how much economic uncertainty is there in news coverage, the change in news sentiment. Again, we're not forcing these to go into the model. The model is selecting these variables as the things that have been the best forecasters of S&P returns in our estimation window. Const just means a constant. The lagged one-year return, the lagged earnings growth is important, and the level of the VIX squared, actually. The VIX is an index of short-term implied volatility on S&P 500 options. Notice that the price to earnings ratio, which is one of the forecasting variables, is not being selected. Notice that the earnings yield minus risk-free rate, which is another one of the forecasting variables, is not being selected. Why? Because those variables in our estimation window were not actually good at forecasting S&P 500 returns. So but these variables were good. So when you look at these variables that have actually been working, and you look at what they're saying, what they used to say 2 months ago is that the S&P will have a return of 19% over the coming year. And what they're saying now, if we kind of refresh the model using more recent values of these forecasting measures, is a forward-looking return of 15% a year. So this is what our model is saying about S&P. We re-estimate the model monthly. The inputs change into the model monthly. We get a new estimate for the model next month, and we use that as an input to our asset allocation framework. So this is what the quantitative tool is saying about the S&P. Now, what is it saying about EM? So remember, based on the valuation metric, EM stocks look much cheaper than US stocks based on their earnings yield relative to 10-year rate measure. Now, indeed, that measure comes in as a forecasting variable into the EM model. So it's right here. This, I mean, sorry for the cryptic notation, but this is the earnings to price ratio minus the risk-free rate. So the model does think that is a good forecasting variable for EM stocks, just not for S&P. But the current forecast for EM stocks, even given this current valuation ratio, given all of the other inputs that go into the model, is a very meager return of 0.5% a year for the coming year. So according to our model, the model likes S&P much more than it likes EM stocks, even though EM stocks based on this valuation measure are cheaper. Now, look, the model isn't perfect. It's not always right. It's frequently not right. However, in our backtest of our strategy with the model, the performance in our backtest has been pretty good. And as Isaac mentioned, our actual launch to date performance has been also very strong. As of the end of last month, we were outperforming our benchmark using this model to do asset allocation, using the separate model for every asset class in which we can invest. We were outperforming by 4.5% over the year that we were actually managing a live portfolio. So with that segue, let me talk a little bit about what we've been doing in our portfolio. So this is a little bit of an overly colorful chart, but it shows you how we've been handling our asset allocation since launch. So when we launched, we had an allocation to REITs, real estate investment trust, S&P value stocks, and high yield. We rebalance our portfolio monthly. Every so often, we rebalance more often than once a month, but typically we rebalance monthly. When we rebalance, we're turning over on average between 10 to 20% of the portfolio, although as Isaac mentioned, that is a parameter that goes into our portfolio construction tool. So if we would like to dampen that, we can decrease the portfolio turnover if people are particularly sensitive to realizing capital gain distributions. So, you know, I won't bore you with everything that we've done, but what I want to point out is that there is a lot of tactical variation what the model does over time. The model has been heavily invested in S&P this whole year. It's not always like that in our back test. The model often, you know, has only 30% allocation to S&P. It's not mechanically always allocating to S&P. It just has liked S&P this year, which has been an okay call. in relative terms compared to, for example, the NASDAQ. Right now, what our portfolio looks like is we have an allocation to momentum stocks, which is an ETF that holds past stocks that have performed well, which is heavily geared towards energy and consumer staples right now. We have an allocation to commodities that hasn't been that great the last few days. We have an allocation to investment grade. That's been doing amazing this month. I don't know if you've paid attention, but 10-year rates have fallen by about 80 basis points in the last few weeks. So actually our allocation to investment grade bonds has done very, very well over this time. Like there's been a big rally in bonds. And then we have an allocation to S&P 500. So that's what things look like now. And in what's hidden, if you only look at our current snapshot of our portfolio, is how much reallocation happens every month. So the portfolio really does move around, tactically between different asset classes as it sees opportunities emerging from our forecasting model and risk allocations. So our core strategy follows the volatility of this MSCI All Country World Index. Targeting this risk level, what we try to do is achieve the highest possible expected return. So what we're trying to do is we're trying to optimize our portfolio allocation in a way so as to use up our risk budget optimally to create a portfolio that has the highest expected return, given the forecast we have for all of our asset classes from this machine learning sort of data-driven model, but where we are constrained to not take on more risk than this MSCI All Country World Index. So that's our basic strategy. We have other versions of the strategy where we'll run a higher or lower risk than that risk level, but this is the core one. So since launch, the core strategy has, through the end of November, fell by 6.8% after fees. So this is after we've taken out our management fee. The ACWI index during the time is down 11.2% roughly. So we've outperformed roughly by 4.5%, a little under 4.5%. That's been our outperformance. And this is currently giving you our portfolio allocation. Okay, so that's where we've been on the portfolio side. This is what our performance has been since we launched, and this picture showing you what our current allocation looks like, which is an allocation to commodities, to the US stock market, to corporate bonds. And this factor means it's like the momentum factor exposure we have through our momentum ETF. The two different color bars, we measure our exposure in two ways. The blue bar is just a fraction of our portfolio that's invested in that asset class. The yellow bar is the contribution to our risk coming from that asset class. The reason they're not the same is because, for example, corporate bonds are much less volatile than stocks. So even though we have 10% of our portfolio in corporate bonds, the actual risk contribution of that position is considerably lower than its portfolio allocation. So that's the distinction between the blue and the yellow bars. So this is what the portfolio currently looks like. And as a final thing, I just want to highlight, and then we can open it up to questions if anyone has any, is we've been working on a tool to help investors think through their savings decisions. Basically, we have a tool that allows investors to sort of work with an advisor to project forward their anticipated earnings stream, to project forward their expenses, and to see how that interacts with their portfolio allocation. And the key insight from the tool, from our analysis so far, is that it's not correct to say, I'm going to do a 60-40 stock bond allocation, and the way that I'm going to project my future wealth is to just say stocks every year return their average return, and bonds every year return their average return, and let's see what happens. The reason that's not the right thing to do is because of volatility, because when you are invested in stocks, they can move around more than bonds. So our tool allows people to model the correlation between the investable asset classes and to think about their allocation to riskier and safer asset classes in the context of their anticipated future net savings stream. And then the tool allows you to run a simulation and basically simulate forward a hypothetical 30-year path of the investor's wealth and see what happens. So what this is showing you, each of the little light colored curves here is showing you one of the simulated paths. So this is a portfolio where an investor is invested, I think it's 75% stocks, 25% bonds. We specified a hypothetical earnings stream for the investor, hypothetical expenses stream. Of course, this should be customized to a particular client. And then we basically simulate the stock and bond return and keep track of all the possible outcomes. And the thing to note is that if you look at the average outcome, okay, the average outcome for this household is in 30 years, the household will have $10.8 million in wealth. That's this blue line. The median one, which is the outcome that is where half the outcomes are above, half are below, that median one is 9.4 million. Okay, that's fine. That's looking really at the averages. But I think investors should worry a lot about sort of the less good outcomes. If you look at the less good outcome, like the worst case, which is like right here, that's the worst simulation we ran using kind of historically calibrated risk numbers for stocks and bonds. In the worst case of all the simulations, this household would only have 2 million in wealth. That means like a really bad 30-year period. You know, the first percentile, which means the simulation that was, you know, worse than 99% of all the other ones, was 2.7 million. Now, the 75th percentile, this is the one that was basically better than 75% of all the simulations, was like 13 million. The point is not to get lost in the numbers. The point is that this is a tool that allows people to write down a projection of what they think they will earn, how much they will spend, what they will save, then modify their portfolio allocations and see, okay, if I have a 50-50 portfolio, what does the distribution of my future wealth look like? Am I okay with the less good outcomes? If I'm 75-25, what happens? Or let's say I start off 75-25 and slowly transition to 30-70, where I'll have 30 stocks, 70 bonds in 30 years, and I'm sort of transitioning over time from my current one to that target. Like, what happens to the distribution of my wealth in 10 years, in 20 years, in 30 years? And am I comfortable with the less good outcomes? So we think this is a very useful way for people to think about their savings decisions and also how those interact with their portfolio allocation decisions. And we'll be writing and sort of giving more information about this tool in the coming weeks and months. But I just wanted to highlight it for you here. So, so that's it. That's all I have. So thank you for listening. And now we can open it up if anyone has any questions. We'd love to hear from you. And if you don't have any questions that you want to ask us now, please reach out to us. If you're not on our email list, sign up. If you want to contact us for other reasons, please click on this link, and we would love to hear from you. So
Thanks, Harry. I do have a question. I think that it flows more with logistics of how you do what you do for RAs and independent advisors if they're considering utilizing you as a sub-advisor or in-source chief investment officer. Can you briefly explain logistically how you manage, for example, an RA's allocations or portfolio? You know, some people may be familiar with sub-advisors and OCIOs and ICIOs, some may not, but to help those to overcome the inertia or understand better how you do what you do, can you explain that? And obviously you're multi-custodial, you can do it on many platforms. And yeah, we'll just start with that and I'll have a follow-up question too.
So do you want me to touch on that, Harry? Do you want to?
Sure. Yes.
Great.
Please.
So we have a few different options. Number one, we are on Schwab and we are on Interactive Brokers. On either of those platforms, you can simply assign us essentially as an account manager and we can manage. If you are on another platform, all you have to do is let us know. We handle the vast majority of the process on our end to make it very simple for you. We can very likely get on your platform and just become an asset manager on that platform. You click a button and we can manage for you. Another option is we can send you the trades every month. So, you know, you sign up with us and then each month we'll just tell you the allocation. And the final option is, you know, as an OCIO, you can just give us a login and username to your existing account, just as you would to one of your employees. And we can log in and handle the trades that way. So our goal is to be as flexible as possible and you know, do whatever is most convenient for our RIA clients.
Thanks for that, Isaac. And I just want to add to it too, that really what you intend to be is an in-house chief investment officer and allocator for an RA, so that it looks like you're part of their team. You could be part of their website, but you also provide either white label or your own commentary, just like this, just like the presentation that Harry just gave. You put out monthly commentary, and all that is part of your offering and your services. Whereas, when someone used to, for example, maybe be at Merrill Lynch and UBS, they have a chief investment officer there, and they have themes and they have write-ups and they have predictions for the year for the clients. That's what what QuantStreet can be for independent RAs and advisors.
Yeah, that's exactly right, Jake. I mean, we have a lot of analysis in the style that you saw in this presentation. We're very analytics and data driven, with a layer of common sense applied to it all. This could be the label as a white label product, so you can sort of brand it as your own. If you want to brand it as QuantStreet, that's fine with us. I mean, this is all content we can deliver to our clients, and we can also do bespoke analysis for clients. If you have a situation that you want us to think about, like you have a client and the client has some unvested stock, and that represents 40% of their wealth, and how do you create a portfolio around that existing position to think about the correlation of that existing position with the asset allocations that we may want to put into the client's portfolio. I mean, that's a sort of analysis we'd love to work with you on as well. So yes, we very much, we are small. We are going to listen to our clients. We'll be available to talk to, which differentiates us from, the much bigger players of the world. So absolutely, those are the kind of services we're looking to provide folks.
Thanks, guys. Anyone else have any questions they want to ask Harry or Isaac?
Sure. So why don't Nathan I saw, and then Artem after.
Yeah. Hi, Professor. Long time no see. Yeah, it's been a while. Yeah, yes. Since I did a case study video over the summer of 2021. So, yeah, my quick question is regarding the yield curve inversion. You mentioned that the spread between the 10-year and 2-year Treasury yield is widest since several decades. And yeah, I get that it doesn't necessarily mean that the stock market will also underperform with a recession, but I think it should be pretty evident that the spread should narrow down in the future. So do you ever bet on those yield curve spread narrowing down in the future? Yeah, I know interest rate doesn't short or leverage anything, but yeah, just wondering.
Right. So that's a good question. So to answer your question, to bet on yield curve flattening is a very highly leveraged trade, right? Because what you're going to be doing is you're going to be buying 2-year bonds, you'll be shorting 10-year bonds. The duration is very different. So you'll be doing it at like a 5-to-1 ratio. That's not our bailiwick. This is not the kind of stuff that we do. So we have an asset allocation bucket to basically longer term treasuries and short-term treasuries. So implicitly in there is an allocation decision between them. Right now, the model doesn't like either one of them. It likes investment grade bonds. Why? Because the yield is much higher. Like the yield spread between investment grade and treasury is like 150 plus or minus. I haven't checked it like today. Investment grade bonds are heavily geared towards the banking sector. The banking sector is super well capitalized. Like this is not 07, 08, 09. So that extra 150 basis points of yield looks very attractive to the model. So it basically has us take our duration exposure through investment grade. I traded credit back in the day, levered, curve trades. I mean, that's not what we do. That's just not our strategy. So yes, I agree the curve will obviously flatten, will become upward sloping, but it's all a question of how long will it take. If it takes 3 months, you make money. If it takes 9 months, you don't make money. So there's just so much going on in those trades. That's just not variables. That's not our that's not our value added.
So there's no way to use the ETF products to mitigate the risk components or anything like that?
Well, look, from an asset allocation point of view, you can decide to allocate to 2-year bonds or 10-year bonds. There's an ETF that tracks both, basically. I mean, the trade-off is, 2 year, you have the yield of like, what, 4.34%, but that might be short-lived. In the 10 year, you have 3.5%. You may get that, you're going to get that for like 10 years. So, that's the trade-off. Our model magically will allocate between those two things, but right now it doesn't like either one. So, but to do the relative values, just like we would not do that.
Oh, okay, makes a lot of sense. Thank you.
All right, sure. Or Artem, sorry, you had a question.
Thank you very much. So I have a following question. I see that in your asset allocation, you have now exposure to commodities, and now in commodity sector we have very, I think, unusual historical situation with price cap on Russian seaborne oil. I don't know whether there have been a similar case in the history that such price cap was implemented, and we all pretty well know what happens once central banks are trying to implement such kind of currency corridors and trying to regulate the currency against its natural tendencies. Often it happens that it can be well. Sometimes it leads to currency crisis, like it was in 1998 in Russia, for example, exactly because of currency corridor in place. And in respect of oil, it is oil price is a global price, and such involvement of political regulation into the oil price, can it lead to the oil price shock like in 70s, for example? And then in your presentation, you showed that in that time there was quite high inflation volatility, which was resulting then in high correlation between bonds and equities. So do you think we can have or see such a scenario that political involvement into commodity sector, into the price cap, and now what we hear to the price floor? So this is forming this pricing corridor, which is leading then in the end to in a short term to oil price shock.
So, look, I think this is absolutely one of the tail risks that's in the market, is all of the repercussions of the conflict in Ukraine, including what will happen to energy prices. So look, it's a political decision that I can't, that a lot of very smart people made. But what economically, what ends up happening is you're basically constraining the supply curve. You have your famous, you have the supply demand curve. People are supplying a commodity, and you're saying you can't supply it at a higher price than this. And so basically they don't produce, and it typically causes shortages of that commodity. And so you have the demand curve at that price is like all the way to the right, and the supply is just cut off, and you have an imbalance in the market. So how does the imbalance manifest itself? I mean, probably what it means is that, this is sort of the tail case scenario, but the price cap inhibits investment in Russia. They don't maintain oil fields, so a lot of supply comes off the market. In the short term, OPEC doesn't, increase supply. In addition, they don't invest enough. Somehow over time, that as demand continues to grow, as China emerges from its COVID-19 lockdown phase, demand grows, supply is not kept in line with demand, and at some point, all of it mixes into a brew that causes higher oil prices. So look, that is a tail risk. It is a tail risk. I mean, there's other scenarios where, Saudi Arabia has spare capacity, they bring it online, and this sort of thing doesn't happen. With God's help, this whole thing in the Ukraine normalizes in the short term, and then Russian supply goes back in the market. So, so these are the kind of things that are hard, to forecast. I mean, I don't think anyone really knows, but I think you're right that this is one way things could play out. I mean, the way our portfolio is positioned is we have our forecasting models. The reason commodities makes it in there is really for two reasons. One is the forecast for commodities, three reasons. One is forecast for commodities, which it's the only asset class that is up year over year. So that it's kind of that momentum part of the signal looks good. Second of all, it's weakly negatively correlated with bonds. So having bonds and commodities looks attractive from an asset allocation point of view because of that correlation. And the last thing is there's nothing to squeeze it out of the model in the sense of like every other asset class that has a current return forecast looks less attractive than commodities at the moment. So our allocation to commodities is not huge. It's like it's 6.5% of the portfolio, so it's not huge. But you know, it sort of gets it gets in there through that combination of things. And you know, I mean, again, one of the benefits of having a systematic strategy is that at the end of the day, we're not making these decisions on behalf of the model. We put in our ingredients, the forecast happens, we do a quantitatively driven asset allocation, knowing that there are things in the world that it doesn't know about. That's true. I mean, look, I actually have a paper that I've been working on with a colleague from Columbia and a colleague from the Kansas City Fed, where we're trying to forecast energy prices using news data. I can tell you it's hard. We have like a 60-page paper. It's very hard to forecast commodity price, not only using news data, using everything else we can throw at the model. That's a hard forecasting challenge. There's just so many things that go on. But you know, the way it fits into our portfolio is it's a small allocation. If the correlation of it fits well, and you know, if this tail scenario materializes, having commodities in the portfolio will be a little bit of a hedge against, you know, the thing that bad shock that can happen. So that's how we're thinking about it.
Thanks, Harry. Hey, we need to wrap up and move on, but I think that it would be great to have a follow-on call about these questions, more OCIO services. So for those that are watching the recording, for those that have been on the call, you know, reach out to Harry and Isaac or reach out to us at Apex if you want more information or to set up a Zoom call, customized one-on-one. And it will have more of these educational webinars that will include market data, but also, you know, more about what QuantStreet can do for RAs and advisors. But thank you, everyone, and we'll get this recording out to those that are both on and those we'll speak to in the future.
Thanks, everyone.
Thank you.
Happy holidays.
Thank you very much.
Happy holidays.
Bye-bye.
Bye-bye.